Welcome. This is Chapter 1 of Intermediate Financial Accounting. This is Volume 1, Business 353, which is Intermediate Financial Accounting Part 1. And here we're talking about the Canadian financial reporting environment. Which in particular is the CPA Canada Handbook. And the CPA Canada Handbook is composed of 4 parts. One is the International Financial Reporting Standards, or IFRS. That's the set of Canadian standards that apply to public companies. Then the next part, Part 2, is Accounting Standards for Private Enterprises, often called ASPE. And that's basically small and medium-sized businesses, and is less complex, GAAP. Then there are 2 other parts. Part 3, Accounting Standards for Not-for-Profit Organizations, and Part 4 deals with accounting standards for pension plans. The text and the material in this course deal with the first 2 parts, IFRS for public companies and ASPE for private enterprises. Both IFRS and ASPE are required for year ends beginning on or after 2011, and of course we're far past that now. Private enterprise is one that hasn't issued and is not in the process of issuing debt or equity instruments that are or will be outstanding or traded in a public market. So a private enterprise doesn't hold assets in a fiduciary capacity for a broad group of outsiders as one of its primary businesses. If your enterprise fits that requirement, then it can use accounting standards for private enterprises, which is essentially the old Canadian GAAP created by the Institute of CPAs. Now, in this chapter, many students tend to skim through this chapter and perhaps dismiss it as of little importance since it doesn't contain any numbers and debits and credits, the things you might believe accounting is all about. But the chapter does provide a good opportunity to think about how to build your own framework and perspective on the discipline of accounting. So it can be done by emphasizing the broader role of accounting in society and what it is that we as accountants actually do. Accounting in society is a source of information about economic activity and involves much more than just making bookkeeping entries, and it deals with measurement and reporting alternatives that have an impact on resource allocation in our society, both at home and internationally. So this is also a good time to point out that the links between accounting and other courses in the curriculum, such as finance, economics, management, and organizational behavior. There's a whole list of required accounting courses, both on the financial side and on the management side. This is the first at a relatively advanced level. So we use some of the techniques from finance and some of the capital market context that you might have discussed in your economics classes with Gerda, and other management and organizational strategy courses also have implications that you can see through the accounting courses as well. Our learning objectives. After we finish this chapter, you should have some idea of how to explain how accounting makes it possible to use scarce resources more efficiently. So the idea is we allocate scarce resources to those persons or corporations who can use them most efficiently and create the most value for society. We'll talk about number 2, explaining the meaning of a stakeholder, and we'll talk about who the key stakeholders are. Obviously, the major ones for accounting purposes are shareholders, both potential and current investors, but they also include creditors and employees and society in general, particularly with regard to environmental responsibilities, the government and their taxation authority, Statistics Canada in measuring how well the economy is working, those sorts of things. Number 3, we'll identify the objective of financial reporting, what it is we're trying to do. 4, we'll talk about information asymmetry. That means information which isn't distributed evenly. And generally we're thinking in terms of management versus shareholders there. And we'll talk about how bias interferes with the objective of financial reporting. And as a consequence, number 5, we'll talk about the need for accounting standards and look at the major entities that influence standard setting and financial reporting in Canadian financial reporting. We'll talk about what GAAP means, generally accepted accounting principles, and We'll talk about professional judgment, and this course is essentially the first introduction of significant professional judgment in dealing with accounting choices. Then we'll talk about some of the challenges and opportunities we face in accounting. So we can look at the outline of this chapter in terms of this slide. So the financial statements and financial reporting considerations will include the idea of accounting and how it helps with capital allocation, the identification of stakeholders, the objective of financial reporting, and information asymmetry and how accounting standards help to distribute the information from inside the holders of private information to the others who need to know the private information. We'll talk about the standard setting, the need for standards and who does that. We'll talk about GAAP and what it means, what professional judgment does, and then we'll talk a little bit about some of the continuing challenges and opportunities for the accounting profession. So, why accounting? Well, world markets are becoming increasingly intertwined internationally. So also due to technological advances and less onerous regulatory requirements, investors are able to engage in financial transactions across national borders. We weren't allowed, 20 years ago, we weren't allowed to make investments inside RSPs, registered savings plans, which is the tax deferred savings platform that was allowed. We weren't allowed to make investments in the US or internationally. Now those are allowed investments, and so we can invest across national borders in our tax-free accounts. Also applies for TFSAs. So investors are able to engage in financial transactions across national borders and to make investment, capital allocation, financing decisions involving foreign companies in foreign countries. As a result, an increasing number of investors are holding securities of foreign companies, and a significant number of foreign companies are found on national exchanges, both in the US and Canada. Second, accounting is a service activity. It's a descriptive or analytical discipline, and so it describes what transactions have happened, the stewardship of management on behalf of shareholders, and it analyzes and measures things in terms of unique accounting measurements. It also constitutes an information system where one group is providing information to another group. So it may be the idea of accounting may be defined, as it says in this slide, as the process of identification, measurement, and communication of financial information about economic entities to interested persons. And so that definition is commonly used to describe what accounting does. The basic idea is its purpose is to help the interested person make decisions about the economic entities and whether they want to invest in them or support them in other ways. The focus of this text is on the subset of the accounting discipline known as financial accounting or financial reporting. This subset is concerned with the accumulation of financial information for the purpose of developing financial statements that report on an entity's financial position, the result of its operations, and its cash flows. The generalized format of these financial statements makes them useful to individuals both inside and outside of the organization. So financial accounting is generally for outside users and managerial accounting generally for inside users, although financial accounting certainly does have implications for managers as well. A principal means of communicating financial information to those outside the enterprise is the financial statements. Excuse me. So the financial statements would include the basic financial statements of the balance sheet, also called the statement of financial position, the income statement, which may be called the statement of comprehensive income, the statement of cash flows, and the statement of changes in owners' or shareholders' equity. And so there's a little bit of difference in terminology used in IFRS versus ASPE. So IFRS, the terms which are used in IFRS are the statement of financial position, statement of comprehensive income, statement of cash flows, and statement of changes in equity. The ASPE standards tend to use the older terminology, balance sheet, income statement, statement of cash flows, and statement of owner's equity. Note disclosure is also part of the financial statements. So make sure that whenever you're reading financial statements that you consider the notes as well. They provide information about the disclosure within the body of each statement. And so additional financial information is often provided by means of financial reporting through other mechanisms as well, such as the President's Letter, the Management DNA Discussion and Analysis, supplementary schedules in the Corporate Annual Report, reports filed with government agencies, prospectuses when they're issuing new securities, news releases, press releases, those sorts of things. And so that information may be required either by authoritative pronouncements or regulatory statutory requirements or other regulatory agencies, or it may be just disclosed because management wishes to do so on a voluntary basis. And there's quite a difference in voluntary disclosure from required disclosure, and there's a difference in how that information is used. The economic activities of a business enterprise represent a complex network of events that shape the financial position and the results of operations and cash flows of the enterprise. However, for these economic activities to be meaningful, they must be properly identified, measured, organized, and reported on in a manner that effectively serves user needs. And so here we have a list of affected users or stakeholders. Accounting is the process by which the individual economic activities of an enterprise are accumulated into useful financial reports. This information affects perceptions of financial position and financial success, and so these perceptions can lead to changes in behavior, investing or divesting behavior, ultimately other decisions about the company. So financial reporting affects a number of users. Here we have a list of users, both internal and external: investors, creditors, unions, other employees, government agencies, as well as management within the firm. The major financial statements, as we've listed: the statement of financial position, statement of comprehensive income, cash flow statement, and statement of changes in equity, plus note disclosures, constitute the financial statements and external financial disclosure, and the other forms of financial reporting which we talked about. President's Letter, or also called MD&A, Management Discussion and Analysis. Other publicly disclosed information is listed here as well. So the idea of financial reporting is that it aids users in the allocation of their scarce resources. So society, there's a limited number of resources available for investing, and so one of the purposes of accounting is to help with capital allocation. So the fact that markets and free enterprise determine whether a business is successful places a significant burden on the accounting profession to measure that performance accurately and fairly on a timely basis. So investors can use the financial information provided to assess risk and relative returns associated with investment opportunities, and thereby channel their limited resources more effectively. In Canada, the primary exchange mechanisms for allocating resources would be debt markets, equity markets, and other financial institutions. An effective processing of capital allocation promotes productivity, encourages innovation, provides an efficient liquid market for buying and selling securities and obtaining or granting credit. So when information is unreliable or irrelevant, poor capital allocation results, and the society suffers as a result. So the accounting profession actually has a responsibility for fulfilling that societal objective of capital allocation. So the capital allocation process, basically we think of investors and the households who have extra capital that they want to invest at a profitable return so that they can use the money to provide retirement income and other consumption needs. They have extra money that they want to invest. Companies need money to be able to buy financial assets, and they use those assets to run their business and create additional value out of the resources available to them. So the allocation process is aided by financial reporting that reports, first of all, what the company has done in the past. So it's a stewardship perspective, tells investors what management has historically done with invested funds, and allows them to draw inferences about what they can expect management to do on their behalf later. Other stakeholders would include those who have something to risk as a result of financial reporting. So if we go back to the users we talk about here, back here, these users. Key stakeholders would include the traditional users of financial information, investors and creditors, who rely directly on financial information for resource allocations. But in broader terms, stakeholders include the traditional stakeholders as well as those who help in the efficient allocation of resources. So that would include financial analysts, auditors, unions, industry groups, customers, employees, regulators, all of whom review, audit, monitor information for different purposes. So stakeholders would also include management, and management actually have a stake in the information because they're preparers of financial information, and they are often evaluated in terms of the results of the financial information. As a company grows, you may start with an initial project or idea, and the only people you can convince to give you money would be the founders of the firm, yourself, your family, your friends, people who believe in you more than really believing in the idea. Then as you convince more people and as you gather capital, you begin to develop prototypes and other ways of describing what it is you're doing. You may do additional research and development. You may develop prototypes. At this point, you might pursue angel investors. So these angel investors are the ones who would, again, believe more in you than in the product or service in particular. When you've got it to the commercial stage and you're able to actually demonstrate that it would be a profitable investment, then venture capitalists often get involved at that point. And so these are people like the Dragon's Den investors who would give you some support, and usually they take a fairly hefty piece of the initial profits because they're taking a lot of risk, right? So there's usually a requirement that you pay a substantial reward to them, and then at some point you go public and become part of the public listing. So the TSX Stock Exchange, Toronto Stock Exchange, as the graph shows here, at the early levels, you may be on the junior exchange or the venture exchange, as it's called. That's basically penny stocks. They're often referred to as penny stocks because they're less than $1 or so is the cost of the shares or the value of the shares. And so you would start with a non-public listing, just talking to people you can get capital on a one-to-one basis. You may be able to convince the venture exchange to add you to its listing, and so you can get some capital investment at that point. When you're actually a public company, then you actually acting as a public company with significant capital market participation, then you might actually move on to the big board, which is the Toronto Stock Exchange. And that's the major stock exchange in Canada. Okay. So we've talked about the stakeholders. In particular, stakeholders are the people who would monitor or use financial information to help them make their decisions. And so you could think about each of the people in this list of key stakeholders and how they actually use the information and what's the purpose of financial information for them. Employees, of course, use financial information to determine whether or not you want to stay working for the company, whether you want to begin working with the company, whether you want to, if you're a member of a union as an employee, you may use the financial information in bargaining, collective bargaining agreements. So you can see that there's a number of stakeholders in financial reporting that would be important to consider. The primary ones, the traditional requirements of financial disclosure, the primary clientele, as we call it, are the investors and creditors. So those investors and creditors rely on financial statements to make their decisions. I think I might have lost you there. My apologies. I lost my headphone connection. I think my battery was going dead. So let's begin again. Stakeholders in financial accounting, the major ones are the investors and creditors. And so we set generally accepted accounting principles to provide direction to them in providing financial reporting information. If you think about the interest of each stakeholder, there's a table here taken, I believe, from your textbook that describes different stakeholders and how they use financial information and what is at stake for each stakeholder, so what it is that they're interested in. The investors and creditors, of course, are looking for a return on their investment. Management uses financial accounting information often as a way of determining the amount of their bonus payment, their salary increase, their ability to move from job to job, their what we call in economics and financial accounting theory, their reservation wage, the amount that they expect to get paid as a result of their experience and their training. Securities commissions and stock exchanges look at financial information to make sure that it actually describes what has gone on with the business, and if the auditor doesn't give the company a clean audit opinion, it's quite likely that the securities listing will be suspended. So it's quite important that the auditor provides an independent opinion that the financial statements do accurately reflect the transactions of the company. The objective of financial reporting. The objective of general purpose financial statements is to provide financial information about the reporting entity that's useful to present and potential equity investors, lenders, other creditors in making decisions in their capacity as capital providers. So general purpose financial reporting is to provide at the least cost the most useful information possible to a wide variety of users. Capital providers are the primary user group, and so they have the most critical and immediate need for information in the financial statements. Investors need the information to assess the company's ability to generate net cash inflows and to understand management's ability to protect and enhance the assets of the company. The entity perspective, one of the perspectives on financial reporting. The entity perspective means that the company is viewed as being separate and distinct from its creditors and owners, so it's separate from its shareholders. Therefore, the assets of the company belong to the company, not to a specific creditor or shareholder. Financial reporting focused only on the needs of the shareholder, which is the proprietary perspective, is not considered appropriate accounting standards. Decision usefulness. Decision usefulness, the information should be decision useful, so useful to the users for making decisions. It means that information contained in the financial statement should help investors assess the amounts, timing, and uncertainty of prospective cash flows from dividends or interest, and the proceeds from the sale, redemption, or maturity of the securities and loans provided by capital providers. So in order for investors to make these assessments, the financial statements and related explanations in the financial statements must provide information about the company's economic resources and the claims on those resources and the changes in them. That information is generated using what we call the accrual basis. And the accrual basis of accounting starts with the recognition of revenue and then matching the related expenses to that revenue to the extent that they can be matched. So we use the accrual basis of accounting because it provides a better indication of a company's present and continuing ability to generate favorable cash flows than just a cash basis, which reflects only cash transactions. Now, ideally, to facilitate the flow of capital in the most efficient and effective manner, all stakeholders should have equal access to all the relevant information And in other words, there should be an asymmetry of access to information. So information symmetry as opposed to information asymmetry. Of course, that's not the way it always works in practice, although that's good in theory. Management might feel that disclosure of all the information may hurt the company's competitive advantage. So you want to give private information to your competitors, which will allow them to take market share away from you. So for this reason, and other reasons, perfect information symmetry doesn't exist. And as a general rule, management rightly has access to more information than others since they run the company. So they have what we call inside information. In other words, there is an information asymmetry. Accounting and economic theory tries to help us understand these issues. The efficient markets hypothesis proposes that market prices reflect all public information about the company. And there are two common types of information asymmetry we talk about. And the two common types of information asymmetry problems that are studied by academics are adverse selection and moral hazard. Adverse selection is where information asymmetry exists and the capital marketplace may attract the wrong kind of company or the wrong kind of investor. And so companies that have the most to gain, the adverse selection might actually attract the wrong type of investors, the ones that have sorry, let me run this by. Let me start again. I think I'm getting lost. So adverse selection is where information asymmetry exists, and this is selection before you actually enter into a contract. So you might actually not get the right kind of investors, the right kind of participants in the market. So in general, you might not be able to attract certain kinds of investors because they don't trust management. So you may not be able to, your market might fail on the basis of not having everyone participate in the market because they don't have information that they can trust. So if management is going to lie to you on the financial statements, you probably don't want to let them have that opportunity, so you probably won't invest in the company. So that's one of the issues, one of the information asymmetry problems for capital markets, is that people remove themselves, they select out of the market because they can't trust management to behave in ways which are consistent with the shareholders' objectives. Moral hazard is after we actually enter into a contract. So moral hazard includes the idea that when you hire a manager, if you've already given them your money, the managers may no longer have an incentive to behave in ways that are consistent with your best objectives. So if you're not able to monitor them all the time, they may be shirking their responsibility, and that management shirking is an expensive thing for you as an investor. It's not exercising good stewardship of your funds. So moral hazard is the idea of human nature, refers to human nature, and notes that people will often shirk their responsibilities if they think no one is watching. So it would include ideas like management bias. They tell you stories that they think you want to hear as opposed to what actually happened with their business, with their management of the business. Aggressive accounting, so accounting that makes it look like income is higher and assets are more valuable, as opposed to conservative accounting. Conservative accounting would be lowering the value of assets, considering the most conservative value for assets and revenues. And so one of the purposes of accounting information is to minimize the potential for managers to actually bias the financial statements in their interest. So some of the possible motivations for that management bias could include your evaluation of their performance, and particularly compensation related to that performance. It may include access to capital markets and meeting analyst expectations. So if management has not met analyst expectations, that tends to have a very negative effect on share values, and the share values going down means that their bonus would probably also go down. There may be contractual obligations, so the debt covenants, which we probably talked about before to some degree. The idea that if you borrow money, you generally have debt covenants which say that you can't do some things. So there are negative covenants which say you can't pay dividends in excess of a certain percentage of income. That would be a negative covenant. A positive covenant would be one where it says you must do certain things, so you must maintain a certain debt equity ratio above, or I guess you want to keep a debt equity ratio below a certain level, right? So you must maintain a certain number of assets or a certain liquidity of assets. Those sorts of things could cause management to bias the financial statements if they're not actually meeting those contractual obligations on the face of the financial statements. So the financial statements that result from the accounting process are based on a conceptual framework, and that conceptual framework helps us to make decisions in situations where we're not given specific direction. Accounting standards developed by the accounting profession are part of the accounting standard setting process. So they want to set the accounting standards to provide a body of accounting theory and practice that is generally accepted, so generally in the society, in the practice of business, and generally applied to companies so that you can actually compare their financial statements. So accounting standards, the idea is that it helps reduce the information asymmetry problems of adverse selection and moral hazard. It reduces adverse selection because there's an independent assessment through the audit process of the financial statements. So it provides some assurance that the financial statements do actually reflect the transactions of the company. In addition, the audit process limits moral hazard because management is not allowed to bias the information unduly in their own best interests because of the presence of an independent auditor and independent accounting standards that allow you to compare one management's performance against other managements of different competitive firms. So the body of accounting theory and practice in GAAP, generally accepted accounting principles, helps to promote comparability in the preparation and analysis of financial statements. The accounting profession in each country, including Canada, has developed a common set of accounting concepts, standards, and procedures known as GAAP, generally accepted accounting principles. And that serves as a guide to the accounting practitioner in accumulating and reporting the financial information of the business enterprise. So the ultimate adoption of some generally accepted accounting principles has caused some controversy among accountants as well as members of the financial community. However, a majority of the members in each group recognizes the ultimate benefit that a particular accepted set of accounting principles can bring to the financial reporting process. So it is somewhat a political negotiated process in which the majority, after substantial consultation, the majority determines what appropriate accounting disclosure is determined to be. So in Canada, the standard setting process in Canada. The key organizations responsible for developing financial reporting standards in Canada include the Canadian Accounting Standards Board, which is the Canadian standard setting body responsible for uniquely Canadian standards. So those are the ones which are ASPE for private enterprises, accounting standards for private enterprises, and for not-for-profit entities, and for pension plans. So those are part 2, 3, and 4 of the Canadian Accounting Handbook. They are not responsible for setting international accounting standards, international financial reporting standards. So within the Canadian Accounting Standards Board, within ASPE, the Canadian Accounting Standards Board is responsible for determining GAAP, basically we call it small GAAP, or financial standards for smaller enterprises. Now the complexity of ASPE is less, so the options are, there's not as usually as many options, and the amount of judgment is not as great in ASPE as it is for IFRS. So the objectives of the Accounting Standards Board would include establishing financial reporting standards and guidance that improve the quality of information reported by Canadian entities, principally annual, interim, and interim general purpose financial statements, with consideration for the costs and the benefits to the preparers and users of financial statements of different categories of reporting entities, and changes in the economic environment surrounding those enterprises. They would try to facilitate the capital allocation process in both the business and not-for-profit sectors through improved information. They would help to They would participate with other standard setters, particularly the International Accounting Standards Board, in developing a single set of high-quality, internationally accepted financial reporting standards, and support the implementation of financial reporting standards and resolution of issues that arise in changes in technology, changes in economic context. The Accounting Standards Oversight Council, the ACSOC, Accounting Standards Oversight Council, oversees the Accounting Standards Setting Board, the Accounting Standards Board's activities in the Canadian Institute of CPAs. The International Accounting Standards Board is responsible for setting IFRS, International Financial Reporting Standards, and this body was created in 2001, and its aims are stated as follows. The aims of the International Accounting Standards Board is to develop in the public interest a single set of high quality, understandable, enforceable, and globally accepted financial reporting standards based upon clearly articulated principles. So that's the conceptual framework we talked about. These standards should require high quality, transparent, and comparable information in financial statements and other financial reporting to help investors, other participants in the world's capital markets, and other users of financial information to make economic decisions. Their second aim, I guess, would be to promote the use and rigorous application of those accounting standards, and C, in fulfilling the objectives associated with A and B, to take account of as appropriate the needs of a range of sizes and types of entities in diverse economic settings. So different countries, different sizes of business, multinationals versus local single country entities, those sorts of things. And finally, to promote and facilitate the adoption of international financial reporting standards, being the standards and interpretations issued by the International Accounting Standards Board, IASB, through the convergence of national accounting standards and IFRS. So there's still a continuing negotiating process between the IASB and the FASB board in the States. The Financial Accounting Standards Board in the States sets the U.S. Terms of accounting standards. Key things about international financial reporting standards. It's for public companies. It must be used by public companies. Private enterprises can use IFRS, but they're also allowed to use ASPE under the constraints that we talked about before. If they have a public presence through public issuance of debt or of shares, or if they have a significant public presence in society, they should use IFRS. But in general, private enterprises have the option of using IFRS, but they also may use ASPE. In the States, the FASB, Financial Accounting Standards Board, is a board which is created by the Securities and Exchange Commission, which is at a federal level, whereas in Canada, the financial securities legislation is at a provincial level. So in particular, the Ontario Securities Commission, which oversees the TSX, is the major securities commission dealing with Canadian public companies. The international standard setting structure is composed of 4 different organizations: the International Accounting Standards Committee Foundation, the International Accounting Standards Board, which sets the standards, an IFRS Standard Advisory Council, SAC, and an International Financial Reporting Interpretations Committee dealing with smaller issues that new issues that haven't been addressed before. So they provide some initial guidance when it gets to be a significant enough issue as it gets actually passed along to the International Accounting Standards Board for development of stated recommended accounting standards. So the trustees, who are part of the International Accounting Standards Committee Foundation, select the members of the IASB and the SAC, the Standards Advisory Council, and they fund the activities and oversee the IASB activities. International Accounting Standards Board in turn develops in the public interest a single set of high quality and understandable IFRS standards for general purpose financial statements, and the IASB relies on the expertise of various task groups formed for various projects and on the Standard Advisory Council. The SIC consults with the IASB. The Standards Advisory Council consults with the IASB on major policy and technical issues and also helps select the task force members. The International Financial Reporting Interpretations Committee acts as the problem filter for the IASB, the Standards Board, leaving the board to work on more pervasive long-term problems. So it addresses controversial accounting problems as they arise and determines whether they can quickly resolve them or whether to involve the International Accounting Standards Board in solving them. The IASB has a thorough, open, and transparent due process in establishing financial accounting standards. So financial standards adoption consists of the following elements. There's an independent standard setting board, which is overseen by a geographically and professionally diverse body of trustees, including Canadians. A thorough and systematic process is in place for developing financial accounting standards. They engage with investors, regulators, business leaders, accountants around the world, different bodies of accounting professions. And so there's a consulting process. Exposure drafts and discussion papers are issued for comment. And they're also responsible for collaborative efforts with the worldwide standard setting community so that financial standards apply universally. They follow specific steps in developing typical IFRS standards. They identify the topic and place it on the board's agenda. Then they do some research and analysis and publish discussion papers. And so it's basically analyzing the pros and cons. They allow public hearings on the proposed standard. They evaluate research and public response and issue an exposure draft, which is the sort of first draft of the proposed IFRS standard. And then they evaluate responses and change the exposure draft as necessary to achieve general acceptance. And then the final standard is actually issued. The IASB is organized in a particular way, meant to insulate the members of the IASB as much as possible from the political process, from lobbying by favored industries and national cultural bias. So the membership consists of 14 members from 7 different countries, serving 5-year renewable terms. Up to 3 members may be part-time members. The autonomy of the IASB is ensured. So the IASB is not part of any professional organization, so it's not a member of the CPAs of Canada, and the CPAs are not a member of the IASB. It's appointed by the International Accounting Standards Committee Foundation, and it's only answerable to them. It's supposed to be independent, so full-time members must sever all of the ties with their former employer. So if you're going to work for them, you need to sever all your ties with your other partners of your firm. Members are selected for their expertise rather than to represent a particular country. And then 9 of the 14 votes is needed to actually issue a new IFRS. So it's a fairly significant chunk of the votes. The IASB issues 3 major types of pronouncements. I'm getting behind on my slides here. There are international financial reporting standards, and so far the IASB has issued 13 different IFRS standards. And the previous international standard setting body, the International Accounting Standards Committee, had issued 41 international accounting standards, IAS standards, and those that have not been amended or superseded are still considered under the umbrella of IFRS. They provide a framework for financial reporting, which is an attempt at developing a conceptual framework that would serve as a tool for solving existing and emerging problems in a consistent manner. However, the framework is not actually an international financial reporting standard and doesn't define standards for any particular measurement of a disclosure issue. It's more of a way of thinking about IFRS. So nothing in the framework overrides specific international financial reporting standards. The standards themselves are the standards that bear on accounting choices. They also issue international financial reporting interpretations, and these interpretations are issued by the Interpretations Committee and are considered authoritative and must be followed. 17 of them have been issued to date, and they cover things like newly identified financial reporting issues not specifically dealt with in existing IFRS, or issues where unsatisfactory or conflicting interpretations have developed or seem likely to develop in the absence of authoritative guidance. The IASB doesn't have a regulatory mandate. It doesn't create laws. It doesn't have any enforcement mechanism per se. It relies on other regulators such as the SEC or Ontario Securities Commission to enforce the use of its standard. For example, the European Union requires publicly traded member country companies to use IFRS, and any company indicating that it prepares its financial statements in conformity with IFRS must use all of the standards and interpretations. The hierarchy of authoritative pronouncements is, first of all, IFRS, and then if it doesn't do an adequate job, you look at the IAS standards developed by the previous International Accounting Standards Committee, and then finally interpretations issued by either the IFRIC, Interpretation Committee, or its predecessor, the SIC. The requirements and guidance and standards and interpretations dealing with similar and related issues may be considered the framework, the conceptual framework, and most recent pronouncements of other standard-setting bodies such as the FASB that use a similar conceptual framework. In the United States, let's back up here. In the United States, whoops, slide's not working. In the States, the Financial Accounting Standards Board is the major standard-setting body. Although it doesn't have final authority over standards, instead the Securities and Exchange Commission does. The SEC has confirmed its support for the FASB by stating that financial statements that conform to FASB standards will be presumed to have substantial authoritative support. US GAAP has and will continue to have a significant impact on GAAP in Canada, and since Canadian GAAP is based on principles and is fairly open to interpretation, accounting professionals have often relied on the more prescriptive specific guidance provided in US GAAP. So GAAP in the US tends to be much more specific for particular disclosure recommended in particular cases. Second, many Canadian companies are also listed on US stock markets and exchanges, so they consider FASB as authoritative in their accounting principles as well. Provincial securities commissions have laws and legislation. That require companies that issue shares to the public and the shares that are traded on a Canadian stock exchange are required to produce GAAP financial statements. Stock exchanges as well as securities commissions, in particular the Ontario Securities Commission in Toronto, have the ability to find a company and or delist the company's shares. So compliance with GAAP is essentially mandatory. Generally accepted accounting principles includes not only specific rules, practices, and procedures for particular circumstances, but also broad principles and conventions that apply generally, including underlying concepts. So as mentioned previously, GAAP is the standard followed by public companies, private companies, pension plans, and not-for-profit entities. So GAAP is divided into primary and other sources. Primary sources must be looked at first, but if a primary source does not specifically address an issue, then the entity must use accounting policies that are consistent with the primary source through the use of professional judgment in accordance with the conceptual framework embodied in the relevant part of the CPA Canada Handbook. For public companies, the primary sources of GAAP incorporate IFRS, IAS, and IFRIC interpretations. Under ASPE, Accounting Standards for Private Enterprises, the GAAP hierarchy requires users to first consider the Handbook Part 2, sections 1400 to 3870, which include appendices, and second, accounting guidelines including appendices, also included as part of ASPE. These are the primary source of GAAP for private enterprises, and other sources are noted in section 1100 of the CPA Canada Handbook Part 2, and they include background information, the basis for conclusion documents issued by the Accounting Standards Board, Accounting Standards Board's implementation guidance pronouncements, approved drafts of previously non-existent primary sources, research studies, accounting textbooks, journals, studies and articles, and other sources such as industry practices. So, under IFRS, GAAP includes the IFRS standards first, the IAS standards issued by the previous body, interpretations in the IFRIC pronouncements or SIC interpretations, and then additional information as sort of secondary sources. Professional judgment. While IFRS and ASPE provide important guidance, The resolution of many issues regarding financial statements, statement reporting for particular companies and circumstances must still rely on the heavily on the exercise of professional judgment. Professional judgment plays an important role for Canadian and international accountants due to the basic philosophy that you can't issue a rule for every situation. The U.S. currently does use a more rules-based approach, and so that's one of the areas where the Canadian standards, the international standards, and the FASB U.S. standards disagree. Professional judgment reflects the ability to make an appropriate decision regarding unfamiliar and changing situations. Exercising professional judgment requires a thorough knowledge and understanding of IFRS and ASPE and reflects education, experience, and ethical choices. And of course, this the coverage in this course is essentially the same coverage as the introductory course in financial accounting, but it includes an analysis of significant professional judgment issues. So the big difference between this course and its coverage and the initial introductory course is the development of professional judgment. Challenges and opportunities for the accounting profession includes, in the States, the Sarbanes-Oxley Act, often called SOX. Sarbanes and Oxley were the sponsors in the Senate and the House of Representatives for this act. So the Sarbanes-Oxley Act refers to those two legislators. The financial reporting environment in Canada and in the US is changing rapidly, and government regulation in the capital marketplace has increased due to some major corporate scandals, particularly Enron. WorldCom would be another one. The Sarbanes-Oxley Act was enacted in 2002, and it gave the SEC more resources to fight fraud and poor reporting practices. In addition, an accounting oversight board, the Public Company Accounting Oversight Board, PCAOB, was established and given oversight and enforcement authority. In Canada, stronger independence rules, management accountability measures, and codes of ethics for financial officers were also put into place. Essentially, the effect of these measures has put more emphasis on government regulation and less on self-regulation of accounting disclosures. So some of the legislation's key provisions are listed here. Independence rules. Auditors are no longer allowed to offer other services. If you're the auditor for a particular public company, that's the only service that you can offer them. You can't do tax, you can't do consulting, you can't do other things. Now, in Canada, the Canadian response includes the Canadian Public Accounting Accountability Board, which has a similar role to the PCAOB in the States. And additional rules were issued by the Canadian Securities Administrators, including, as we said, management accountability measures, management's responsibility for the appropriateness and fairness of financial statements, where managers actually have to sign off on a disclosure statement that says that they understand that the financial statements do fairly disclose the transactions of the company. Independent audit committees are committees formed of the members of the board of directors who are independent of management, and so can actually act on behalf of the shareholders. And other increased disclosure requirements have been added as a result of the major corporate scandals in the US. There have been some Canadian counterparts as well, where companies have done things which were viewed as being accounting manipulation, and some very large companies have gotten in trouble for that. I'm trying to think of the major one, which used to be a major part of the Toronto Stock Exchange value, and it's escaping me at the moment. So I just looked it up on Google. Nortel was the company, and that company was a fairly major telecommunications company and had substantial market capitalization, and they were actually given a slap on the wrist because of their aggressive management bias and disclosure. So it's happened in Canada as well, as in the US. So it's not just us, or not just them that got in trouble. So because accounting information is supposed to help in decision making, it can influence behavior, and so ethical behavior by accountants is crucial to maintaining the integrity of the accounting profession. So, in accounting, ethical dilemmas are encountered quite frequently, and the steps that may help in the process of developing ethical awareness and resolving ethical dilemmas are often listed as follows. We need to recognize that it is an ethical situation or dilemma, first of all. So second, move towards an ethical resolution by identifying and analyzing the principal elements in the situation. Then part C, identify alternatives and weigh the impact of each alternative on various stakeholders. And finally, select the best or most ethical alternative considering all the circumstances and the consequences of those circumstances. So, ethics is something we talk about. We actually have developed a code of ethics for accounting profession members. So the CPAs actually have to sign off on a code of ethics which says they will behave in certain ways and not behave in other ways. It's largely written in terms of sacrifice of personal individual objectives to society's needs, and so it's a very sacrificial view, which is kind of an interesting approach to our responsibility to society in general. Now, while politics does influence the development of standards, it's not necessarily a bad thing, given that the economic impact of those standards will be implemented in society at large. Nonetheless, politics should not be the main motivation for standard setting, so special interest groups are other stakeholders that will fight to get what they want as well, and more and more companies as they adopt IFRS in diverse political climates, cultural, economic, social, and legal needs of the countries involved would need to be considered in the standard setting process, but there are specific safeguards built into the selection of international accounting standards setters that we've just discussed that reduce the liability or reduce the likelihood that particular interests will be followed through setting of accounting standards. A key issue with standard setters in various jurisdictions is the principle versus rules debate. The U.S. tends to take a more rules-based approach, kind of like the Canadian tax system, and there's a rule for most things, even though the rule may be based on a principle. There are specific rules that deal with specific situations. So the result is that the body of knowledge is significantly larger because you have to write more rules for more situations. And unfortunately, the rules-based approach doesn't always emphasize the importance of communicating the best information for users. IFRS and ASPE are both more principles-based, and so the body of knowledge is smaller. And the idea is that one or more principles form the basis of decision-making in many different situations and scenarios. In addition, professional judgment is fundamental to the application of a principles-based set of standards. There's less emphasis on right and wrong answers. Rather, financial reporting is a result of carefully reasoned application of the principle to the business facts. In a principles-based body of knowledge, bright line tests are minimized, and bright line tests are a term we use for numeric benchmarks for determining accounting. Other changes in the financial reporting environment are characterized by the following. Globalization of companies and capital markets results in a greater need for comparability of financial information across different countries. Technology, as technology continues to advance, the need for timely information is rising sharply. Things can happen very quickly, and changes can happen very quickly in the technology markets. So a continuous reporting model is already under discussion in the capital markets. Increased requirement for accountability, and this has been in part brought on by the increase in institutional investors who have greater investment knowledge and representation on corporate boards. In addition, CPA Canada has several initiatives dealing with risk management, governance, and performance reporting that take a broader view of an all-inclusive business reporting approach. Integrated reporting is a term that comes up from time to time that incorporates aspects of financial reporting as well as measurements used by management to evaluate the business, including non-financial information, and information regarding opportunities and risks, critical success factors, management and shareholders, background about the company. Business reporting can also include reports on environmental matters, human resources, technological issues. A balanced scorecard model, which is developed by management accounting, takes financial, customer, internal processes, and learning and growth perspectives of a company to help a company achieve its strategic vision by developing objectives within each perspective. And so there are a number of key challenges and opportunities for the accounting profession that still exist. And that's it for the chapter.